Hello, traders. It is Wednesday, April 16th, and we are doing a live event today. Harry, how are you doing?
I'm spectacular. How are you, Pete?
I'm doing good. I'm not only surviving these volatile markets, I'm actually making money. I know you have been too. Been
Hand
some
over
crazy,
fist.
been some crazy moves the last couple of weeks. So right now we've got a bit of a market decline here after the bond auction results. And look at this long green candle given up very, very easily. I am looking to short futures in here, but I want to see us stay below the VWAP for at least a few bars here. So I'm not jumping into a trade right now. We don't really have any previous trades to review. I'm going to review HIMS. That was the last one that I highlighted in Sunday's video on Monday morning. I saw this pullback in the stock and I was able to sell the April 25th $23 puts for 50 cents. I love that trade. I think they're currently trading about 30 cents. I'm just looking for very high option implied volatilities on relatively cheap stocks so that I can sell them out of the money. You can see the stocks at 28. That $23 strike price is even below this support level. So stock's been holding up well. It's got relative strength. And in the next week, basically, tomorrow, last trading day of the week, in a week, I'm going to generate somewhere around a 5% return. And that trade only took me about 10 trading days. So it's a really nice return. Those types of trades are out there, especially when option implied volatilities are super, super high like this. So increase your odds. It's just a moment of clarity when you have chaos all around you, and it's because of those high option implied volatilities.
Yeah, selling puts is and you've been hitting this hammer for a while. Selling puts is the way to go when that happens, certainly. Particularly when you get stocks like Nvidia or Tesla and you get this incredible IV on the delta 0.1 puts.
You have been successfully trading Nvidia, and you're still trading it, aren't you?
I am indeed. I've been knocking that stock around. Took a hit this morning because of the news overnight, but then I shorted it. Then I shorted it. Took a profit. Now I'm going long. I'm going to take a profit on the upside. I'm just going to go back and forth on it until I feel it's settled down. It's interesting because in this market, Pete, as you mentioned, it's a crazy market, and we have so many new traders coming in. I really hope all of you right now that are new traders, you have not yet established yourself as a profitable trader. By that, I mean consistently profitable every month. You can depend on taking your profits out of your account, pay bills, do things with it. That you are paper trading, maybe trading one share if you're at that stage. If you're jumping in right now and hitting future contracts or trying to grab some options and you're using real money, you're going to be in for a world of hurt with this market. This is a great time to learn with this volatility. A great time to get your methods together, but it is a dangerous market for those that are unprepared to meet it.
That's a really excellent point. And in my 30 years of trading, I've only seen a few periods of volatility like this. And I'm talking absolute monster market moves with 80.5-minute bars. You don't see that very often. In fact, last Wednesday's long green candle that we had, I've seen that a couple of other times. One I recall was during the financial crisis when the Fed very wisely waited until the very last minute. They waited until the eve of options expiration. And back then they were all monthly options expirations. And they announced a bailout. I believe that was the TARP bill and a rate cut. And we got a similar short covering bounce like this that absolutely screwed short sellers. And that's why they picked that day They wanted to inflict
Hmm.
maximum pain on short sellers. They wanted everyone to think twice about selling short because the market was in trouble. It was in a free fall. Our whole financial system was coming apart at the seams. So, if you're going to make money on the short side and that's how you were playing it, then you were going to take some massive pain. And so you can expect things like that. They will time these events to the degree that they can, but typically they're going to come after a big drop like this because that's when they know they can catch shorts off guard. And this long green candle right here, you can see it hit that resistance at the 550 level. So anybody that needed to cover did. And when we get one long green candle like this after a heavy round of selling, well, we usually expect that that could be what we call a solo. It's a one-off. What would have been more daunting for short sellers is if you broke this candle into four and you stack those four candles up consecutively, that is persistent buying. That is a show of force on the side of buyers. This, on the other hand, it's just kind of a one off mechanical thing where once the programs kick in, once the short sellers get squeezed, it feeds on itself and it runs its course very quickly. They see what's up there and they go, yeah, that petered out pretty quickly. And now all of a sudden you're seeing the market roll back over and we're back below AVWAP-Q. I view this as significant. I wanted and I was hoping that we would spend more time at this 550 level, gradually getting up to it. And then as earnings season unfolded, we would start to see some cracks in the dam. Well, we may not make it to that point because ASML came out yesterday with, or this morning, I should say, with a fairly weak look at what future uh, demand was going to be. And a lot of that is uncertainty around the tariffs. The point is that it gives us some insight on the semiconductor space. NVIDIA took a $5.5 billion write down on Chinese chips, and that's why that stock is down. So just not a great backdrop for tech right now. And I'm suspecting that we may not get back up to 550 and we may just start leaking oil right back down again now that the tariffs are going to be raised to 245%, I believe, on China is the latest news.
Um, someone wrote an interesting story I want to respond to in the chat there, but always remember to zoom out. When you're in a heavy news environment, and Pete mentioned AVWAP-Q, that certainly is zooming out. Technical, if you're in a day that's nothing's going on, let's go back, a year ago or whatever, and it's like you get a 30-50 cent move on SPY during the day, very narrow range. You can zoom in and the technicals like regular VWAP and the 8 EMA, they're all going to come into play, and price is going to respect those boundaries unless there's some sort of news that pops up. But when you're in an environment like this, the technicals begin when you zoom in, begin to weaken, right? And you need to zoom out for those longer term, the 200 SMA, the AVWAP-Q, all of these long-term trend lines. Those are what start to come into play because you're in a very sensitive news environment. So you just got to be aware of the context in which you're trading in, whether it is a technical heavy environment or not. Right now, we're in an environment where you really need to be leaning on the long form technicals, the daily chart, the 200 SMA, things that I talked about, rather than focusing in on those technicals that you normally would have on your basic SPY's up $1 type day. So just wanted to wrap some context around the heavy news environment that we're in.
I am ready to short here also. So I'm looking at this was a reaction. We were into the gap, probably a little bit of short covering in here as we started to fill that gap. And look at these nice, steady red candles. Boy, was that whacked down immediately. This is the kind of persistent selling that I was talking about. And this is the kind of solo that I had mentioned earlier, except on a daily chart. And when you see these long candles like this, especially on a breakout, you do not chase. You have to make sure that it is legitimate and that it's not a one-off like this. So if you spend a little bit of time at the top of this candle and then you gradually start grinding higher, awesome. It's going to take time to digest those gains, and eventually buyers will show that they are still there and that sellers were not able to beat that thing down. But most of the time, you're going to see price action like this, and it's going to retrace. And if you bit on that nice breakout candle, that long green, you're going to really regret it, because everybody else that got in here is getting flushed out here, and they're thinking, God, I wish I wouldn't have done that.
Someone wrote a weird story here about Dale Perryman sold 10 SPX 0 DTE short call spreads 35 wide on the Trump tariff pause day. He had stops in the short call, was stopped out in the mega move up. After being stopped out, he closed a long leg. His broker left him a voicemail saying 4 of his trades have been busted, and he woke up to 116,000 in losses. That's literally impossible. You on a spread, on a debit spread, right? You cannot lose more than the debit. So if you have, a 490, 500 call debit spread and 10 points wide, and you spend $4 for that, so $400, you do 10 contracts, the max you're losing there is $4,000, period. Now, could you lose a little bit more if you're closing out your short calls prematurely? Yeah, but you're not losing more than the spread itself. So the maximum your loss there, even if you did everything wrong, is $10,000. If you're closing out the short calls the wrong way in the long calls, there's literally no way someone is going to lose $116,000 on that spread. Even if they lost every point of that spread, your max loss there is $30,000 on 10 contracts. So I don't know what that story is or where you found it, but I guarantee you that's not what happened. So just it goes to understanding what debit spreads are and what credit spreads are and what your exposure is in those spreads.
Well, let's see.
By the way, are you in any positions here, Pete? I am short Tesla, which is doing well. I'm up 65 cents in that short. I have a counter trade on as a long Nvidia, which is pairing with my short Tesla. What do you got?
I am short USB from this morning at 37.90, so I'm about 30 cents off on that one. I thought that nice little crackdown earlier today below the EMA 8 and the fact that it found resistance at this low right here was going to be providing horizontal resistance. So I'm pretty good staying short this. In fact, a lot of the financials have been reporting. They've reported in the last week. The initial reaction was good, but that quickly ran its course. And here you can see over the course of the last week, XLF hits resistance right here at the 200-day moving average, and now it's starting to back off slightly. This is also a horizontal resistance level. So I'm getting pretty comfortable shorting banks in here because they've reported earnings. And one of the things that we're currently fighting is that we've got earnings season heating up over the course of the next 2 weeks when we get back from Easter weekend. And so as more and more of those earnings come out, I believe there's going to be a little excitement going into the numbers. And then I think the air is going to get let out of the balloon. And I think the guidance is going to be very soft. And then I think the market will be able to retrace much more easily. Shorts are a little scared after that long green candle last week. They're playing it a little bit safe as they start to get clarity that, hey, earnings season and earnings releases weren't that big of a threat. I think you're going to see short sellers become a little bit more emboldened again. So yes, banks,
I
think are.
If you think, Pete, to me, one of the big fears here is that we're going to have a lot of companies suspending guidance. They're just not going to give it. They're going to cite such economic uncertainty that they're going to suspend their guidance, and that could lead to a lot of volatility.
I think you're right. I'm suspending my guidance too. If you ask me what the market's going to do, I'm going to tell you I have no freaking clue. How am I supposed to know what this is going to do? It's all over the board. I do suspect that we're going to see another leg down, though. Just everything. If you just look at what the technicals are telling us, I think that we're starting to hit resistance, and that with that news, we're going to have more clarity, and the clarity is going to point to the downside. And as much as the focus is on tariffs, if you look back at my forecast for 2025, it's the global economic backdrop. That is the problem. That's what the problem is. The tariffs aren't helping issues, they're increasing uncertainty, and they could push us a little closer to that recession more quickly. But the problem is that global demand has been declining for about a year. And that is my biggest fear.
I mean, what happens is certainly, you take tariffs as an example or any of these, the market can adjust itself to some consistency, right? Okay, there's going to be tariffs on this sector, this area, this country for X amount of time. Okay, now you can make decisions, right? You can say, well, we're going to move manufacturing, right? However, if you are a company, do you decide, you know what, we're going to move manufacturing to the US, open up a factory and all that, and then find out 3 months later that, oh, those tariffs were lifted or they were changed? We are tariffing semiconductors. We're not tariffing semiconductors. These are now, NVIDIA news overnight. The H20s are now banned in China after 3 days prior. The article that came out that said there would be an exception for the H20s. So there's just this general uncertainty. So you're looking at a lot of these stocks, and we've got some questions here on long-term investing. And when you're doing long-term investing, which we don't do, and so that is not, there's no financial advice here on long-term investing. Long-term investors will look at things like PE ratios and forward guidance and all of those fundamental aspects of a company. And sure, if you look at NVIDIA right now, it's got a forward PE of like 15. That's incredibly low. And that's a good deal. But these things could continue to drop, right? As Pete was saying, the economic landscape is now very, very different than what it was. And there's a lot of uncertainty. So you have to wait for there to be clarity to find out if you're in a situation where these are good deals or not good deals. That is why we prefer short-term, using the price action to guide us. And long-term, if you're long-term holders, a lot of people are just, not looking at their account and hoping that they'll open it up a year from now and things will be better.
Getting some questions. I always get asked, Peter, the reliable news sources that you use. I get this. I must get it every single time I do a video. I use everything. I look everywhere. No, there is not one silver bullet solution. But what is it? What do you look like? I could list 500 different sources of information that I use. I am scouring everything. I watch YouTubers. They have great information. I probably have 20 of them. I'm not going to list them all because I just start searching around. And if the topic's interesting to me, I'll watch 3 or 4 minutes of it and I'll know instantly if the guy's full of crap or if he actually is pretty knowledgeable. If he is, then I'm going to listen to what he has to say. I use Fred. That's the Federal Reserve's website, FRED. Search for it. Tons of data points, tons of statistics in there. I look at forward guidance from earnings reports. Every single earnings report. I look at news feeds like Bloomberg, Reuters, Wall Street Journal, everything. You gotta look everywhere. There's no one source for news. So roll up your sleeves, spend some time, and do some digging. That is what you have to do. I don't visit CNBC very often. I primarily will just look at what their pre-open markets are showing as far as overseas markets, but I don't read their headlines at all. And most of those have like a editorial slant to them as well. The more pure you can get as far as the actual news that's reflected, you need to be the one that puts the puzzle pieces together. Don't rely on somebody else who's doing that and who is flavoring that content with their own opinion.
And do yourself a favor, try to understand what it is you're reading about. Don't just be like, oh, the dollar is weak against the yen, and this means, because what happens is if you don't understand what that means, if you don't truly get uh what impact that has, why it's important, and so on, then what you are is you're at the mercy of whatever slant whoever's writing the article, whether it's left, right, whatever, pro business, not pro, it doesn't matter. Everyone has an agenda in these articles, right? And they all have some sort of point that they're trying to get across. So unless you want to, be driven by whomever's writing the article, you need to understand these concepts yourself. So do yourself a favor, if you're really going to try to get in touch and in tune with what's going on globally, economically, and so on. So when these news breaks happen, you have a better grasp of them. First, understand what they are, what they're talking about, why it's important, so you can start forming your own opinion rather than being driven by whatever slant that article has.
Ricky, you're asking me a question about.
Profit on my Tesla short.
I've got a question from Ricky. He was watching me do a live event with Dan Inskeep, trying to understand the question. I did buy some calls on during that live session. I was looking for a bounce. I did take a loss on those calls. The market, as I recall, had a spike up to VWAP that did not move very quickly. I exited my long position on futures immediately. I kind of hung with the calls toward the end of the day. And when I didn't get follow through on that bounce, I did take a loss on them. So I don't know. I'm not sure the rest of your question. You have to be fluid right now. I mean, you're watching the market conditions and you're trying to see, as you point out, that sense of urgency. So, well, what does urgency look like? Right here, if you had these stacked candles and you never got this little green series of candles on the opening, you just started selling off, selling off, selling off persistently like this. This is a sense of urgency right here that tells you after 3 or 4 of these, you're going to get some follow through the downside because there's no green candles in between. And when you start seeing price movement like that, that gives you the ability to predict that the next path is most likely going to be lower because sellers are not letting the SPY come up for air. They're just smacking every bid. And as soon as you get down here, and all of a sudden, when I saw this move, I didn't want to see a bounce so early today. I was short in here, and I saw this little bounce, and this long red candle here was erased. I started to take gains because I needed to see more follow through right here. I needed to see this urgency continue lower. And had I seen this pattern much deeper, I would have been fine holding the position because I could see that sellers were clearly in control and they were clearly able to drive the market down much deeper. And then any little bounce like this, I had more gains and I would have been able to weather that, and I would have been looking for follow through selling later in the day. But once we bounced like this, it was apparent to me that buyers did have some say in the price action. They came out and supported the market earlier and they couldn't get anything going on this sell off. So I covered for a small gain. And now I'd mentioned how I wanted to see us pause a little bit in here. I was not going to short when we started today's session. So now we're starting to kind of flatten out And you can see it, the overall price action today has been kind of sloppy, and there's not really any directional movement. So I may or may not be taking a futures trade. We'll see. We'll see how things pan out, but price action starting to slow down a bit.
Which market? What's that, Will?
And let's see, there's a main why you stayed in the calls for 4 hours after you stated you would get out actually happened. Well, I had very little risk in a call position because they were finite in terms of the risk associated with the position. And there was still a chance with this type of market volatility that it would bounce right back. Plus, those options weren't zero DTEs. I still had time until expiration. So if the market recovered midday, then I would have a really nice launch pad to still even consider holding those over the weekend and then getting follow through. But because I didn't see any of that price movement later in the day, and because the market had just leaked lower, it was time to take my loss, look for another day. You've got to be able to take losses. So, I'm not sure what else I can explain on that position. Did I lose money on it? Yeah, I have plenty of trades where I lose money on it, and all of you are going to have those as well. So at some point in time, you have to decide when the position's no longer consistent with what your game plan going in was.
Harry, 4-4 Meta 570, 560 put spread. You closed the short put, held on to the long put at 32 delta, which was dangerous. Did you not go against what you advised? No, if you read the articles in the wiki on debit spreads, there are particular times where, and I made money on that Meta PDS short. I did very well on it, actually. I think I made like, what was it? $19 a call. I made 10 calls. That's $19,000 on one PDS. The idea behind it is that when you're doing a debit spread, you're financing the long call, let's say, or long put, by selling short put against it. And in exchange, you're limiting your upside, right? Your upside is limited to the size of the spread. So in this case here, a 570, 560 put spread, which I believe I got for like $3.90. That means my upside is maxed out at $6.10, right? $610 a contract. However, when Meta moved against it and went up, it's still, looking on the daily chart, qualified to me as a short. It did not violate any of the technicals. So it was still a short I would take. In that case, I took the profit from the short side of the debit spread, and then just let the long puts run. Now, does that increase my loss exposure? Yeah, of course. It probably increased it by about an extra $1.50 a contract, because there's still a $1.50 worth of value in those short puts that I decided when I bought them back to trade in to get the full advantage of just the now financed long puts, because the daily chart on Meta still screams short. Wound up, paid off the next day. We get to crash down, and the shorts worked out. Also, I had a long position on at the time, and I wanted to be properly hedged against the tariff announcement. And the best way to properly hedge it would be to take my profit on the short put, let the long put run, and now I have unlimited upside on what I felt was still a weak daily chart on Meta, that if the market was going to go down, Meta was going to crash with it. If the market went up, I would lose the long puts, whatever value was left in them, but I had my SPY calls going at the time. So I had a balance there, and it worked out beautifully.
I'm going to highlight my short pick. I like Starbucks short. I like that stock short.
Reed hates Starbucks.
Well, yes, I do. I don't, and I don't see other people doing that either long term if the economy starts to head south. Plus, it's brick and mortar. They've got a lot of fixed overhead. they're going to have issues with their brand in China. I don't think the Chinese people are going to be embracing Starbucks when they associate their economic woes with that's Starbucks' second largest market, although I think it's only about 10% of their sales in terms of real estate there. So, but price action's all you need. In all honesty, all the mumbo jumbo that Harry and I have talked about fundamentally, if you just stick with the technicals and you just stick with price action, it's really telling you everything that you need to know. It's nice to have some background information, but the technicals are what you pay attention to. The fundamentals can help to support your decision to enter a trade, but you shouldn't use them as the primary motivation for taking a trade. It's got to be technically based.
For those of you that the video and audio is stuttering a bit, or Will's Wi-Fi and not Ethernet, so you might have that a little bit of that lag every now and then. We apologize.
And see if we can knock through those, and that way, if we go down, at least we'll have addressed most of your questions. So if you would, please post your questions. We'll take a look at them, and we'll try and get to as many of them as we can.
See here. NVIDIA 10:50 a.m. I shorted, but that failed when buyers showed up from the lows. What did I do wrong? You should be in profit right now. You did nothing wrong. At 10:50 a.m. you shorted it, and I'm looking at this here. Okay, buyers did not really show up here after 10:50 a.m. It dropped. It continued to drop. Then it popped up to VWAP, hung around VWAP, and then got rejected and dropped down again. So you could have taken profit anytime in the first 15 minutes after you shorted it. You could have waited for that VWAP rejection, and when that happened, you could have added to the short roughly at around 11:50 because you see that VWAP rejection, and now you have it at the low of the day. So you would have been fine. The only thing you might have done wrong is exiting the trade when it went against you briefly. So you did nothing wrong other than your exit.
What is my thesis on Google? So I am long Google. I did get in poorly on a day trade. It's one of the very few positions that I have on right now. So the beauty of it is I have plenty of staying power. If it takes a week or a month for Google to recover, I'm not too concerned about it. I feel that Google has very low risk exposure in terms of the tariffs. Yes, Europe can impose all sorts of crap on Google as far as some kind of tariff or tax based on their ad revenue, but I view that as pretty minuscule. They'll find ways to perhaps circumvent it, and even for them to impose such rules is going to take time. Plus, I think they already are imposing plenty of taxes on social media in Europe. Google's developing all sorts of AI chips right now, so I feel comfortable hanging on to it. YouTube generates a ton of revenue for Google. If the economy goes to hell in a handbasket, are people going to stop watching free YouTube? Probably not. Okay, so my entry could have been better. I was looking for the market to continue higher. I like the relative strength that I had seen in Google. I'm perfectly content hanging on to it. If I have any long positions on right now, intraday, if I see the market starting to fall apart, what do you think I'm going to do? I'm going to short the futures, for crying out loud. I'm a trader. I can short the futures, and I will be naturally hedged in doing so, or I can short other stocks. And Google, in my opinion, is holding up pretty dang well. Even today, with all the tech news and the tech sell-off, I'm okay hanging on to Google. It's not like I'm long at 210. I'm long, I don't know, about probably $4 or $5 higher. So I'm not like out of the ballpark here. So I'm just going to hang on to it and see what happens. I know the market's been volatile. It's been moving all over the place. It's probably going to move higher. It's probably going to move lower. And heading into earnings season, I think that shorts are going to be scared to be short mega cap tech stocks. So I am looking for it to find a little bit of relative strength into that earnings announcement, which is on April 24th, which is, I believe, 2 weeks from now. So that's why I'm hanging on to that. I've got USB short, and those are my only positions. I've got a handful of naked puts that I'm short. I've already reeled a bunch of those in for pennies. I've got a couple of other positions on. HIMS I've already covered. So that's kind of it. I mean, you guys are asking us. I kind of like having my feet put to the fire, Harry. And you'll notice that every time we get a question, it's like, Harry, why'd you get into that stupid trade? Hey, Pete, tell us about that loss that you had. And that's fair, because us having to explain why we're in a position is perfectly legitimate. And that's a question you're going to have to answer as a trader, because you're going to have losing positions on as well. And you're going to have to justify why you're keeping the position on, why you might add to it, or why you have to exit it. So I hope this is helping you.
Some crazy questions here. Deciding between a Microsoft short or a Netflix long. First of all, Netflix has earnings tomorrow. So why the fuck would you be thinking about a Netflix anything? You shouldn't be thinking about anything with Netflix. Secondly, why would you be thinking about a Netflix long when the damn stock's still down for the day and the market's down for the day? Here's a general rule, and I repeat this ad nauseum. If you are not a profitable trader, i.e. most of you, market down, stock down, don't go long. Market up, stock up, don't go short. Simple as that. You see me do it, you see me do it, great. You can do that when you make a living doing this. Until then, stick with the basics. Market down, stock down, don't go long. Netflix down, market down, don't go long, even if it didn't have earnings tomorrow, which it does, so don't do it. And watermelon here. So on watermelon pesto games, lots of potential shorts are looking almost identically in the last weeks. No, they're not. Do you rather just take one that looks a bit better than most, or do you look through heaps of chart for the best of the best? What do you think? This is what we do for a living. My house, my car, my vacations, they are paid for by trading. It is a business. I have consistent profits. My profits, annual profits, have not wavered between 80 and 85% in 4 years. It literally has been 81%, 83%, 82%, never less than 80%, never more than 85%. And the reason for that consistency is that you follow a particular method. So no, we don't just go, oh, that one looks a little bit better. I can look at other charts, but you know what? I'm just going to short that one, whatever. No, we look and scan and look for the ones that have relative weakness to the market. We look to see how is the market behaving. How is the daily chart? Where is the nearest levels of support and resistance? How far do we have to go before I have to bail on that trade or take profit on that trade? What instrument should I use? Last decision, stocks or options or spreads. All of that comes into it, and then we make a decision on what trade to take. We do not look and go, all these tech shorts, all tech looks bad. I guess I'm going to go with AVGO here. Let's just short. No. We look at it in a very, very methodical way and make the choices. And even then, as Pete said, we're going to have losses, right? We're not going to, no trader is going to be 100%. And if someone says they are, they're full of shit. But it is certainly not a random or more haphazard type environment. Everything is consistent.
Yes. And so, in the chat room and in the lessons that I teach, which incidentally, if you take the free trial, it's free access to my course. You should read it. The wiki is free. If you read that information, you're going to understand what some of those desirable characteristics are that we look for in a stock that helps us distinguish a good short from an average short. And it's checkbox, checkbox, checkbox. You're constantly, every checkbox that's marked increases your odds of success. And that pertains to heavy volume. That pertains to breaking through major moving averages or technical support levels. It's about having heavy volume. It's about the price action that you see, that sense of urgency that I spoke about earlier. All of those things are going to increase your odds of success. So no, every stock is not created equal. Got a little bit of a market drop in here. I'm still anxious to take a short position, and we're breaking below this low right here. This price action tells me that there's decent selling pressure. These gains, or gains on a short. That move is digested here and then whap off of VWAP. So there's not a lot going on today, and we're in the middle of today's range, and that would be one reason that I would avoid taking a short position. The other one is, like I mentioned here, you wait to see what happens on long candles. You do not react to them. You use them as a landmark. If you start retracing the majority of that red candle, it's not legitimate. It was just a program that ran. If you start leaking oil and you have follow through to that red candle, then you can be pretty confident that yes, that is a legitimate sign of selling pressure, and I can start considering taking a position and watching for follow through to that move. And if we do have follow through, then the next support level is the low of the day. We want to attack it. We do not want to poke at it. We want to obliterate it. And if we get that type of price action, then a good short will set up for the day. We also have a bullish 1OP cross, so I kind of want to let some of this cycle run and see if it generates a bounce in here. So I'm just holding off. Low probability trading environment today.
Well, something we haven't talked about in a while is this environment is particularly difficult for traders that use and rely so much on hard stops. I myself, and I've talked about for 4 years, I use mental stops. I don't use hard stops in my trading. I never have. But a lot of traders obviously do. They use hard stops. And of course, if you look at any type of day trading or swing trading guide or whatever, they're going to hit you over the head with use hard stops, use hard stops, use hard stops. But in this environment, right, where your ATR gets blown out of the window, out of the water, and the market is putting in $3-4 candles on the regular, your hard stops are going to get completely destroyed. So you need to reevaluate how you're doing your stops on your trading. Because I'll tell you right now, if you're using stops the way you normally would have in this market, there's no way your trades are lasting.
Yeah, I would agree with that. I mean, the market's all over the board, so you've got to pick your entry points very, very carefully. And I was long last week. I'm trying to think of where that day was. And to give you an idea of what, yeah, this was the day right here. Okay, so this, we got a nice sell-off in here, nice and orderly. Okay, great. Oh, long green candle. We don't bite on that. We got to see if it's real. If you looked at this poke right here through VWAP and what this low was when it pulled back, this was a 120-point S&P drop. Wow. And this little move in here, that was 80 points. Who has that kind of staying power? Very, very few people. And so it might look like it's obvious that the market's going to do this or that, but when you start to actually put numbers behind what the magnitude of these moves is, you realize that, hey, sticking with those positions, even if it's small, is very difficult to do. And a lot of times these programs actually do know kind of what trader pain thresholds are. And I'm sure that they have ways of measuring with the order flow that's coming in. Is this mainly retail based or is this institutional based? And then based on that knowledge and what their programs are telling them, they probably know how far they can push the market to flush individual traders out. So just in support of what you just said, Harry, they know about where those stops are going to be and where those pain thresholds are, and you'll get ticked out of the trade every time.
And I think the stream on my YouTube went out, by the way. Yeah, I'm not seeing it show up there. I went long on Walmart on Monday, but exited for a loss today. I actually straddled Walmart on Monday and posted that straddle. exited for a loss today. You should have exited. Well, I could see why you waited. Yeah, I mean, it just broke through the SMA today. Also went short on Twilio at the same time, the same day, still in it. What do you think? Twilio can't seem to get through. I mean, it's not particularly relatively weak today, but that 200 SMA seems to be right there on the daily chart, and it's sticking. So I would keep the Twilio short on unless it breaks the 200 SMA.
Yeah, I like that. I think that's a good short too. And you can see how it has the one long green candle last Wednesday, and it's been leaking below that 200-day moving average ever since. And it's starting to bite into that halfway point of the long green candle. So I would agree. I would think that this is going to be a pretty decent short for you.
Yeah. Hard to pick a trade here. Obviously, right now, I mean, my God, it's very so market dependent. I mean, I like EVGO short. I do. It's below the 15 EMA. It broke below the 200 SMA. In fact, I may short AVGO now. Let me take a look at it here. I'm just going to short here. I'm going to short 1,000 shares. There, done. At 173.10. So I'm shorting AVGO at 173.10. That would be my recommended short right there.
I like being short Starbucks at 82. Carry that position for the next week or so. The only caveat that I would have is that we want to see 550 on SPY preserved by all means. We can be above AVWAPQ, but I'm going to use that as a guideline as well. If we start leaking below it, it's going to confirm that, yes, this is a significant breakdown in here and that this bounce is starting to run its course and that we are probably going to be testing this low sometime in the next few weeks post earnings. So I don't want to get above this level. And as long as we're not above that level, if I am in a relatively weak stock, I'm going to hold the line and I'm not going to worry that I'm not profitable in the last hour or in the last day. I'm going to be watching longer term for that stock to come in. Would I, and by the way, would I bail out on Google? No, I'm going to be short. I will be short more than I am long if the market breaks down. And eventually, if Google really looks like it's relatively weak, which I don't see that right now, then of course, yes, I'll exit the position and I'm not going to hang on to it on post earnings. I'm not going to hold on to it over earnings. And I'm looking for that little positive pump up before the earnings announcement. I'm sorry, Harry, what were you saying?
Yeah, I mean, I want people to pay attention to the little thing you're doing with Google. I do it with NVIDIA. There, in an environment like this where it's incredibly hard to swing trade, right? And because NVIDIA is NVIDIA long, right? And because there could be a news break at any time that's just going to blow a position out of the water. However, yes, we talk about how we ignore fundamentals, but look, is Google never going to get back to the entry point that he got it at? Of course it is. It's fucking Google. It's going to get there. Can he hold that position? Of course he can. Right now, if you went long Google and that tied up your whole account, right? And you can't hold that, let's say, it'll take 4 months for Google to get back to its starting point. All right. If you can hold it for 4 months, it's still trade with your account and you have plenty of liquidity, great. But if you just put 50% of your account into Google, or if you used options because you're not using shares and you have a ticking clock on it, well, now you're in trouble. But if he has shares of Google and he can hold it and not impact the rest of his account, well, it's not like Google's going to fucking go to zero. Google will come back to where he entered it. So there is a little thing you can use during these turbulent times of swing trading, like, if Amazon all of a sudden became relatively strong and you bought Amazon shares and you went long and then it reversed on you, it's fucking Amazon. It'll come back. But not if you allocate your whole damn account to it. And if you're using shares, unless you have a large enough account to hold a decent number of shares, most of you are using options. That's where you get into the problem. That's where you can't swing it. But don't forget, Pete is using shares on Google here. Very different than if he went long Google calls.
That's a great point. And I wanted to also talk about something you had just said, which was, this is a tough time to swing trade. Well, we made a shit ton of money in here and in here when the going was really good for shorts. And I mean, I know I can't even tell you how many S&P points I took out of that and how many shorts we had that made a ton of money. So down in here, what was I telling everyone? We're going to get a bounce. We're going to get a bounce. We're going to get a bounce. This is a time to go to the sidelines. This is not a time to be aggressive. We got a bounce. So now you lay low, you let the bounce play out, knowing that the next big move is going to be down. And we still have all this mixed garbage, newsy, no sense of direction in here right now. I believe the next move is going to be down, but we wait, and we wait. And the problem that most traders have is they feel like they always have to have something on. I've got to be right every single day, and I got to do 5 or 10 trades a day. That's just not how trading works. It's the blackjack player who's sitting at the table. Is he making big bets? Hell no. He's waiting for the odds to line up in his favor. Then he puts his money down. That's what you have to do. And if you're not patient, you're going to piss all your capital away and you're going to get yourself into situations where the probability is very, very low because you don't have that sense of urgency in the market. And then you're going to scratch your head and go, I don't know how to trade. I don't get it. This is not a good environment right now to be taking big bets. You're in wait and see mode.
Yep. And by the way, my AVGO position up 60 cents now. I noticed it would try to break VWAP earlier. Very weak little bounce above VWAP, and then bam, long red candles below it, broke straight through, no hesitation, and then it continued on down. That was the type of price action I was looking for to take a short on something like AVGO, and it is paying off at the moment. So it's AVGO. It looks like it's hanging around VWAP here. If I start seeing some long red candles that break through it, that might be a nice short. I get the pattern I'm looking for, bam, I jump right on it. So it's, part of it is also just keeping your eye on certain patterns, certain things that will pay off for you. AVGO would be one of them.
And option trading is another point that Harry had just mentioned. What happens when you get a big move lower like this, and you'll see it in VIX, you'll see it in VXX, is look at this gigantic spike up. This means options are expensive. There are people out there buying puts and calls. Are you freaking crazy? I mean, the bid-ask spread alone is big enough for a Susie Max oil tanker to drive through it. So what do the market makers do? This is all on auto quote. So every time you trade options, almost every time, you're trading against a market maker. They do not budge. And so when you have your order out there, they will fill it when they want to and when it suits them. But when the bid-ask spread is a mile wide, you can't trade options. When the option implied volatilities are buying some options again, and you can see how they're buying some options again, and you can see how VIX is starting to decline, and the options VIX is starting to decline, and the options still need to get cheaper in order for us to consider buying puts. So if we happen to get a market drop soon and it comes earlier than I would like, I'm going to short shares. It's going to be the easiest way for me to get in and out of those positions.
All right. What do I feel the difference between the average trader that's looking to make a stable income around 50K a year and a skilled trader that is looking at 100K a year? Starting balance, skill, time. I mean, and what's the difference between a small business and a big business? Trading is a business. You put together your business plan. If you're starting with $25,000 or $30,000, and you say, okay, looking at the 2 years that you should have put into working to learn this, and my win rate and all that, I think I can do $3,000 a month in profit, 10% a month in profit off this account. I'm looking to make $36,000 a year doing that. Then that is your business plan, right? And if after 6 months you say, I'm going to take half of my profits or 9,000, I'm going to put it in the account. So now I have 39,000 as my starting point, and as such, my profits are going to go up. The expectation to 3,300 a month, then you make that adjustment in your business plan. If you have 100,000 in your account and you have the exact same win rate, then you think, all right, I'm going to make 10,000 a month off that, or maybe based on your time of learning how to do this and your journal and your statistics, you're going to do 5,000 a month off that 100,000. So a lot of it is based on the amount you're starting with, right? A lot of it is based on how much profit you can expect a month based on your actual statistics of 2 years of paper trading, of trading one share, of following the method. This is the expectation of it. And how much do you plan on reinvesting? What you don't want, let's just say you have got it to where you're going to make 5,000 a month, 60,000 a year. That is going to be your goal. Your statistics support it and all that. You don't want months that you make 10,000 in that month. You don't want months where you lose 10,000 that month. You want a very small standard deviation. You want $5,000 a month in profit on average, and 95% of the months I make between 3,000 and 7,000, and 99% of the time I'm going to make between $2,000 and $8,000 a month. I am rarely, if ever, going to make less than 2, and rarely, if ever, going to make more than 8. That is what you want. You want that consistency. These people are like, oh, I just made a huge trade. I made all this money. That is not good, because in a week from now, you're going to be saying the opposite and how you lost all your money. Consistency, it is a business. Treat it like a business.
Yeah, experience is super, super important, and experience over many market conditions. Can't tell you how many times I've had someone who thinks that they figured it out. Well, they've been trading a 3-year bull market. Okay, it's easy to figure that out.
Yeah.
The market's very forgiving. And the first bear market, they blow out their account. And we're in that realm right now. A lot of people who thought they had figured it out last year are eating humble pie right now and hanging on by their fingernails, or perhaps they've already blown out their account. So this is a time to tread very cautiously if you've never been in a bear market before. What you see are big dramatic drops. And if you are short, you need to take profits into those big air pockets and wait for the bounce. And then when you get a stalled bounce like we're in right now, then on confirmation, that's when you start considering taking short positions again.
And remember, short positions are always going to be more dangerous and more difficult to manage than long positions. Is part of what makes a bear market so tricky, because what we just talked about, what Pete's doing with Google, you can't do that with a short position, right? You can confidently say Google will come back, right? But if, let's say, you short Google here and the market starts to rebound and tariffs are called off and there's a deal with China and all that, Google may never see 155 again. Right? You could lose everything on that short. So, markets go up in the long run, right? Stocks go up in the long run. It makes shorts dangerous because you can short in a very short time frame, but holding a short over a long period of time becomes very, very tricky to do, whether it's puts, long-term puts, or whether it's shorting the stock. So it's just really, that's one of the things. In a bull market, you're going long all day long on lots of different stocks. You're using calls, called debit spreads. You go long the stock. But in bear markets, you have some stocks that are going to go crazy and you're going to go long on them, but you're going to be doing a lot more shorts. And that is where you can get into trouble.
Option order flow, I think it is a gigantic waste of time. I would not pay for any such services. There are many of them popping up left and right, so everybody has that information. What you don't have is you don't know how they're filtering those out, because oftentimes institutions will be entering spreads. So you don't know what the other side of that spread is. Some companies will filter that out. You also have institutions who have large positions on the other side that they're using that as a hedge for when they do that large option trade. But here's the most important thing. The tail does not wag the dog, period. Everything that happens in the options market is instantly hedged by the market makers because they're on the other side of that trade. And if you're getting size done in the options markets, they know what you are doing because they can see it. They are making the market for it, and they adjust the implied volatilities instantly. They spread out the bid and the ask. So there's no edge to doing that. And most importantly, you don't know what freaking idiot is on the other side of that trade. If I just happened to take a shot and I thought that stock XYZ was going to go higher and I bought 2,000 option contracts, it's going to show up on those searches. Big effing deal. You don't know whether I know what I'm doing or not. Just because I'm trading size doesn't mean that I know what I'm doing. And the final point is that the guy who actually started all this was Larry McMillan in the early 90s, and he ran all these searches and he did find opportunities. His primary thesis was that this is insider trading and these guys are privy to news before a merger or an acquisition. And he nailed a bunch of those plays early on. I talked to him a month ago. He goes, I haven't used that in about 15 years. It's worthless information. It used to be worthy. Now it's absolutely worthless. So no, don't pay for that crap. It's in my opinion, it's worthless information. Follow the stock.
Do you really think I'm going to ChatGPT saying, help me? If you can find anyone who can beat an 80% return, go ahead. No, I have not used ChatGPT to create a predictive indicator. You know why? Because Goldman Sachs and JP Morgan have hundreds and billions of dollars into research, into AI, into creating these indicators. And those indicators that they use and the prediction models that they use tell them what to buy and sell. And do you know how I can figure out what Goldman Sachs and JP Morgan are doing? By looking at the damn charts. Because the price action tells me exactly what they're doing, because institutions move price. I don't need ChatGPT to create something. And if you're trying to find a magic bullet, there isn't one. There really isn't one. There is a method. It is a method that we use. It is a method that works. It is a method that we prove out works because I post every single trade, every entry, every exit in real time, can be confirmed with time and sales to the exact position size. And then you can look back over the last 4 years if you wanted to spend, I don't know, a week of your time doing it and add up all my trades and see exactly how I do because it works. So no, stop looking for the silver bullet. Stop trying to find that I can beat the market if I just use AI now. You're not going to. You're going to lose your money. I can't. I just.
And don't buy any silver bullet solutions that some other guru has come up with using AI, because they're going to charge you a boatload for something that doesn't work. And now everybody's got AI. You know, AI this and AI that. It's everywhere. It's like the .com bubble used to be in 1999. Just add .com and it's crazy. So don't believe any of that stuff. Price is truth. If you follow price action, you're going to understand where those inflection points are, and you're going to understand how to see that urgency that I've been talking about play out in the candles. And when you have motivated buyers or sellers, that's what really matters, because they need to get out now, or they need to get in now. All right. Do we have any other questions here?
Oh, you got one
Harry's,
more?
Harry's still reeling from the AI question. I could tell it's weighing on him.
Yeah. Oh, but
Either that or he needs a smoke, one of the two.
both.
Yes, somebody's gonna throw in a walnut table. That's an inside joke, but it's pretty damn funny. All right. Anyway, traders, this is a volatile market.
Here's an interesting one, Pete. What do you think about this 24-hour trading windows? I think it's going to be a disaster. But this idea that the markets are going to open up 24/7 for traders, that's sort of like just throw them in a casino. But what do you think there's going to? Do you think there'll be an impact on? The only thing I could see is perhaps a dissolution of volume that might get spread, where volume obviously is concentrated into market hours right now, where you get some pre-market and post-market, but most of it's in the market. If you have a 24-hour market, volume might become a little bit wonky as it's spread through over a day. But what do you think?
I think that if there's a natural catastrophe of some sort that impacts some size go off after hours, but the S&P futures have 24/7 trading, well, then the night session must be great, right? No, it's crappy, but it's open 24/7. All the trading takes place during normal business hours in the US. That's when the information that's pertinent to our markets comes out. So that's when you're going to see the majority of activity. So no, just because you're trading 24/7 doesn't mean that all that volume is going to be uniformly spread out over 24/7. It's not going to happen. That's, the companies are going to trade based on the news surrounding that company, and the news comes out during our market hours, or just before or just after. So
Probably
no
be able
impact.
to identify retail volume as the 6 p.m. Institutional volume, I think, is going to stay, as you said, primarily. Rise. I quit a few times. I'll never smoke. I'm no quitter. Just because you're a quitter, always rise. Doesn't make me a quitter.
All right, everybody. Great to do a live event. Haven't done one in a while. We'll try and do one every few weeks, once a month for sure. Just super busy schedule right now. And Harry's live events on X are awesome also. So please make sure he does them on Wednesdays. You do them about 1 o'clock Eastern time, right? On Twitter.
Yep, right around there.
Okay. Well, every video that I do, I'm going to try and post his link to his X events. Maybe I'll go on and try and do the X event. I don't know how what the technology is behind it. Sorry about the issues we had today, but oftentimes it's tough to do these live events with 2 video feeds. So I hope all of you were able to get the information you needed. Have a great holiday, and we will see you soon. Thank you, Harry.
Yep. Thanks, Pete. Bye, everyone.
Trade well. Bye now.